Meta poured $80 billion into a virtual reality ecosystem that users explicitly rejected. They paid a $5 billion government penalty following the largest data privacy breach in internet history. By any conventional metric of corporate gravity, these compound failures should have triggered a collapse. Instead, the company's valuation accelerated. This chart tracks Meta stock momentum, and you can see how markers for global investigations and historic fines barely register against the upward trajectory. In a single recent quarter, while facing active lawsuits across multiple continents, they generated over $56 billion. The question is how a single organization absorbs that level of public catastrophe and converts it into a $1.59 trillion infrastructure that 3.5 billion people voluntarily refuse to leave. Meta does not operate a social network. They engineered a closed-loop mechanical system optimized entirely for human attention extraction. The interface itself acts as a behavioral trap. The pull-to-refresh motion mirrors a physical slot machine lever, triggering a psychological response called variable ratio reinforcement that turns casual scrolling into an involuntary loop. To keep that loop running, the content feed requires intense friction. Internal testing confirmed that posts generating negative arousal and moral outrage produce the highest retention rates, so the system systematically prioritizes anger. We know this exact calculation exists because former product manager Frances Haugen delivered the internal documents to Congress, testifying that the company explicitly measured the psychological toll and chose engagement anyway. Every second of that harvested attention is packaged and sold to 200 million small businesses. A local bakery or a solo entrepreneur can target buyers with absolute mathematical precision, creating a democratized advertising loop that integrates Meta into the baseline economy. This system converts human behavioral data into revenue so efficiently that paying a multi-billion-dollar government penalty requires only a few weeks of normal operating cash flow. The insulation protecting this engine from external pressure lies in the physical and legal architecture of the company itself. Mark Zuckerberg holds 57% of the voting shares. There is no institutional investor, no shareholder coalition, and no board of directors capable of removing him from power. Publicly traded corporations typically answer to independent directors who can block catastrophic risks. Meta bypasses this oversight entirely, concentrating power in a way that mirrors a sovereign autocracy. That structural immunity is why a founder can burn $80 billion on an unwanted virtual reality project without facing a single call for new leadership. But absolute control ends at the edge of the software. When Apple updated its privacy tracking permissions, cutting off external data harvesting, Meta lost $10 billion in a single year because they were tenants on someone else's hardware. The response to that vulnerability was a staggering $145 billion capital expenditure on artificial intelligence infrastructure, building gigawatt-scale data centers to ensure they control the underlying layer of the next computing cycle. This maps the deployment of Meta's open-source AI model, Llama. By giving capability away free, they dissolve competitors' paid models. As the network expands, thousands of startups adopt the free option, tethering directly into Meta's architectural hub. By utilizing zero-cost access as a market weapon, they are shifting from competing for app downloads and positioning themselves as the required baseline for the future internet. Deploying that volume of capital in a single year requires an immediate reallocation of internal resources. This chart overlays the company's record profits against their internal headcount. To finance the hardware expansion, they eliminated 33,000 human jobs, exactly as their revenue hit its highest historical peak. The internal calculation was direct and mathematical. Leadership determined that the yield on server racks and specialized processing chips simply outperformed the economic value of human employees. By liquidating 33,000 positions during a period of peak profitability, the company signaled a permanent shift. They are prioritizing AI infrastructure over human labor. This hardware strategy is gaining its first measurable traction. Sales for Meta's AI-enabled glasses tripled in 2025, suggesting a shift from bulky headsets toward a form factor users actually accept. The plan involves pairing these devices with neural wristbands that read electrical signals from the nerves. If successful, this creates an input method that works without a touchscreen or a voice command. Building this physical layer removes the strategic risk posed by competitors like Apple. These devices represent an attempt to establish a new operating system that bypasses the smartphone era entirely. But while we fixate on the brute force hardware battle, another entity has already won the underlying structural war. They completely bypassed the need to invent new consumer devices, quietly injecting artificial intelligence directly into 1.4 billion existing computers, while the rest of the industry was looking the other way. Under Satya Nadella, Microsoft executed the quietest and most extensive corporate takeover in modern history.